A very good afternoon, everyone. I welcome you all to the webinar on capital market organized by the Committee for Members in Industry and Business, CMIB, of the ICAI, working under the able chairmanship of CA Dheeraj Kumar Khandelwal ji. The committee has been known for its various initiatives, such as campus placement programs for the new qualified chartered accountants, women campuses, career ascent for experienced CAs, overseas placement campus programs, rank holders programs, MDP for general members, CFO meets, HR meets, 40 under 40 awards, and ICA awards. The primary objective of the committee was to consider the matter affecting the members in service, in particular, to consider the problems relating to the career planning, ethics, and other related matters. With this, I would like to first welcome our first guest speaker for the day, CA Kuldeep Kothari. I have this privilege and honor to introduce him to you all. He's a chartered accountant with having an experience of over 13 years with expertise in financial planning, financial reporting, integrated reporting, and ESG advisory. He's an All India rank holder in CA and CS, a fellow member of ICAI, a forensic auditor, and the co-founder of Admin Advisors Private Limited. He's a sought-after speaker and a complete authority recognized for his significant contribution to the financial reporting standards, SEBI, LODR, compliance, and academic research. Today, Kuldeep will be taking us to the SEBI LODR compliances. With this, I give it the dais to Kuldeep. So please enlighten us with the LODR compliances.
Thank you. Thank you, Utsav, for such a warm introduction. First of all, I would like to extend my thanks and gratitude towards the whole team of CMIB as well as our chairman, Dheeraj Kumar Khandelwal ji, for giving us this opportunity to interact with all of you. I also welcome my fellow speaker for the day, Mohit Baseji, who will be taking us through, the hot topic of recent times, IPO and related compliances. If I'm not wrong, you'll be taking this topic only, Mohitji?
That's right, Kuldeep. Thank you so much.
So I'll be, I'll try to cover to the extent possible in the first 45-50 minutes of this session about SEBI LODR, because SEBI LODR is a very vast domain and topic, as well as the regulations are too much to be completed within a time span of within a time period of 45-51 minutes or 1 hour or so. But I would like to cover the recent amendments which have come into SEBI LODR, as well as based on the relevance of give me a second, I'm sharing my screen. Based on the relevance of those amendments which I feel that are more relevant to the industry as well as to the professionals, I will try to cover a bit of everything to the extent possible. Give me a second. My screen is visible, tech support? Yeah, okay.
Now it is visible.
Okay. So, see, the topic of today is capital market for chartered accountant. I think the capital market for chartered accountants or chartered accountants for capital market are synonyms of each other, because capital market is not complete without the contribution of chartered accountants, as well as probably we are not complete without entering into, without talking about capital markets. It is there in our day-to-day life, as well as we do trade, we do invest, we do advise and consult our clients. Not only this, provides us an opportunity of investment, as well as it provides us opportunity in other professional domain also. And one such domain is SEBI LODR, which is, I think, not widely practiced by chartered accountants. Most of the times we see that lawyers or company secretaries are into this particular domain. But I feel that the time has come for us to transcend our role from traditional set of practice to enter into these type of new as well as rewarding fields, I would say, rewarding domains in which we can extend our reach to a larger client base, to a broader client base, as well as we can grow ourselves also. We can be the value adding part in every company's ecosystem, and that's where I feel that SEBI LODR will be in topic or domain to be touched upon in coming years. SEBI LODR recently have seen a lot of changes. Previously, it is an established, or I would say, well matured regulation, which is there. We will discuss the inception of SEBI LODR, why it was introduced, what was the logic behind introduction of SEBI LODR, because I'm assuming that whosoever is attending, there may be a case that some of them are not aware about what is SEBI LODR and why it is applied, on what companies. We all know that SEBI LODR is predominantly applicable or applicable on listed entities only. Listed entities may be in case if their equity is listed, their debt securities are listed, or any other instrument is listed, then the SEBI LODR regulations based on the type of compliance which is required to be made will be applicable. But I am assuming that many of us or some of us are not aware about the same. So let us discuss what is SEBI LODR, how it was incepted, what was the logic behind the same, and then what has happened recently. So taking back to 1992, or I would say prior to that, SEBI LODR, before SEBI LODR or listing obligation disclosure requirement as it is being considered by each and everyone, there was clause 49, there was listing agreement, and how it incepted is incepted from SCRA, that is Securities Contract and Regulation Act. And what is and who is regulating all these things? SEBI, that is the topmost regulator in capital markets. Securities Exchange Board of India is regulating all these things. So prior to SEBI LODR, that is prior to 2015, there was listing agreement. Listing agreement is nothing but it used to be a tri-party agreement between the entity as well as the exchanges and an assumed or deemed party to the agreement, that is the regulator or the government. But there was some flaws into that. There was some multiple type of agreements or multiple type of documents were required to be executed prior to 2015, and with this SEBI introduced these regulations to combine, consolidate, and streamline all the provisions which are applicable to an listed entity or an entity whose any type of security, be it equity, be it debt, or any other type of security is listed on the exchanges. Exchanges are the only source of information sharing between the regulator as well as the investor. They are the only place, be it BSE or NSE. India has two main exchanges, Bombay Stock Exchange and National Stock Exchange. So these are the two places where entities who are listed or whose securities are listed designate the information to be communicated to various stakeholders, and from there only the regulator also picks up if any compliance is not made, if any compliance is made in a different manner, if any compliance is required to be made. So this is the brief about how it started. It started from listing agreement, then it evolved to SEBI LODR 2015 being introduced in September 2015, approximately 9 years back. Then came 2023, in which the SEBI LODR second amendment regulations were introduced. Prior to that, there were changes in SEBI LODR regulations, but predominantly it was unstable, or I would say not that changing kind of regulation. But in 2023, these regulations were introduced. SEBI second amendment regulations were introduced, and major step was taken by the regulator to streamline, to ease out if there is any complexity in for doing the business for the entities, as well as if there is any lacuna in these disclosure requirement, if there is any loophole which is required to be plugged, if there is any transparency, governance, or disclosure related issue, then those all issues were taken care by that SEBI LODR second amendment to Act 2023. These regulations or changes were made effective from 14th of June 2023. Then came the change in BRSR. BRSR is Business Responsibility Sustainability Reporting. It is applicable on top 1,000 listed entities by market capitalization. It came in July 2023. And from there onwards, we are seeing almost there is in consultation paper related to LODR also in every month or two. So there are many changes which have been brought in by SEBI in various type of regulations, be it LODR, ICDR, be it prohibition of insider trading information, about public interest directors, about other changes also in ease of doing in BRSR or other domains where these regulations, LODR, ICDR, or other type of regulations in terms of mutual fund, AIFs, for credit rating agencies. Many changes have been brought into this SEBI regulation domain, and now and often, almost every week or in every 5-10 days, we are seeing that a separate consultation paper comes up for public comments. So there is a set established process in which no such regulation or no such amendment is made in isolation. SEBI first prepares some background material, or discussion is being carried out on a specific change which is proposed, or in a specific amendment which is thought of also within the regulator. Then a consultation paper is floated for the public comments, as well as for other stakeholders. For example, through ICI, there is a committee for financial market and investor protections, through which we also share our views, or I would say ICI's views on various consultation paper. And there are other stakeholders also, like ICSI or other entities, regulators, industry standard forums, ISF as they call. So after receiving all these suggestions, all these public comments, all these recommendations, then again a thorough discussion or consultation is being done, and then in a board meeting of SEBI or otherwise, these regulations are approved or notified. So this is the basic process, how a change or amendment or an introduction of a new regulation works in case of SEBI LODR, as well as other related regulations also, be it ICDR, be it for mutual fund or otherwise also. So this is the brief about these SEBI LODR regulations. As I discussed in the beginning, how it started in November 2022, when a review of disclosure requirement for material informations, material events, as well as some transparent governance communication related changes in terms of disclosure requirements for various listed entities were taken. Then a consultation paper were floated. Then consultation paper for streamlining the disclosure requirement for listed entities for strengthening the compliances was floated in February 2023. Then for corporate governance also, a separate consultation paper was floated for the public comments. Then SEBI approved these amendments in the board meeting held on 29th March 2023. Then in 2023, these notification of these amendments were made, and these regulations, some of these regulations were made effective from 14th of June 2023. Some of these regulations were made effective from 30 days after the date of amendment notification, that is 14th of July. And some of these amendments were made effective from a later date also. For example, market rumors, for example, amendments related to BRSR, for example, amendment related to various other appointment or requirements wherein shareholders approval were required for filling up a vacancy or reappointment of any director, etc., after in specified terms. So there were various dates which were defined in this particular notification, that from which date these regulations will be made applicable. Then master circular was amended in July 23. Then in 2023 July, the change related to BRSR core ESG framework was amended. It was a very well made change, as well as very much awaited change. And then on 17th March 2024, a separate amendment notification was also placed regarding changes in material disclosure of material events, as well as because entities were facing some sort of practical challenge in implementation of these specific amendments. related to market rumor also. So this change was made applicable from 17th of May 2024. Post that also, there were 4 to 5 important consultation papers which were floated. One was in ease of doing business for LODR, one was related to ease of doing business in BRSR, one was related to prohibition of insider trading also, and related to public interest director, as well as extension of definition of related person deemed to be connected person. These all consultation papers are under consideration, but a major event happened in between you know post 17th May and today, when we are taking this session on 22nd of October. A board meeting, the 207th board meeting of SEBI happened or took place on 30th September 2024, and some of these changes which we will discuss in the beginning only, so that you are aware that what all important changes or what all amendments are going in the market. Notification is yet to come, but in principally, like for these second amendment regulations, these changes were approved in 29th March 2023 SEBI board meeting, and they were notified from 14th of June 2023. On 30th September, some of changes which were proposed in previous consultation paper, like ease of doing business, like extension of definition of connected persons, some sort of easing out in disclosure requirement, timelines related to disclosure of penalties, etc., are approved in principally, and rest are under consideration, which we assume that will be which will be discussed and approved very soon. So whatsoever changes SEBI brings in any type of regulation, there are 3 important baselines or pillars of that. One is transparency, one is governance, and one is asymmetry of information. So everyone will think, why all these changes are required? Why so frequently these changes are made? Is there any rationale behind it? Yes, the answer is yes. There is a rationale to each and every change which SEBI is proposing. Are they required? Yes, the changes are required. And what is the basic thought process behind bringing up these changes? The basic thought process behind bringing up these changes is bringing out the best of corporate governance practices in Indian listed entities or the listed space. Second is making sure that there is a transparent and effective communication to all stakeholders. Entities are transparent enough in disclosing each and every event which is required to be disclosed or to be shared with the various stakeholders. And third is asymmetry of information. Let us understand what is asymmetry of information. Asymmetry of information means that there may be a case that I mean to say I am a KMP, SMP, or I am any related party which is associated with the listed entity in any manner, or I am a power broker, or I am a influential person. I have access to certain set of information, a certain type of information which may be not available to public at large or to investors at large, but within the norms or in the common parlance or in the prudence of effective transparent communication, or for making an effective investment decision, these informations was required to be shared with the relevant stakeholders, but they were not shared. And this is called asymmetry of information. At one person or one entity has some sort of extra information which was presumed to be shared commonly, or which was presumed to be shared with everyone, but the other part or other stakeholders doesn't have access to that information. So there was asymmetry of information in many cases, which we will discuss in brief. I would not say detail in the later part of presentation. So transparency, remember this: transparency, governance, and asymmetry of information is something which is kept in mind while making all these changes. And this is why you will see that now and often, in every month, every 15 days, you see a separate consultation paper coming up, and we are discussing it, that whether this change is required, how it is going to impact or have an effect on the market. So the basic changes or the major changes which were made in that second amendment 2023, because I would call it as a base or updated event or a significant event in terms of SEBI LODR regulations. These changes were related to shareholder approvals, corporate governance, related party transactions. Because when you talk about corporate governance, this is a adjoining word, or I would say corporate governance and related party transaction disclosure will go hand in hand, because it is an issue. Transparency or governance, corporate governance and related party, these all things are interrelated to each other. So there were changes related to related party transactions, also disclosure of related party transactions, which on the other hand, in some cases we have seen companies facing some practical challenges also, which we will discuss at a later part. Then in disclosure related to market rumors, disclosure related to material events, other mandatory disclosures which was incorporated within SEBI LODR regulations. Then filling up of vacancies of various KMPs, directors, CFOs, CS, etc. Then there were some changes which was made within a specific intention that if any specific appointment or reappointment is made, then such reappointment or appointment or such action of a company's board will require ratification by the shareholders. So they are not much changes, but there is rationale behind each and every change. So if you want to go and read, understand the SEBI LODR regulations or these changes in detail, I would suggest before going and reading that amendment regulation, you first go and read the consultation paper as well as the background material, and you will find rationale or logic behind each and every change which is introduced by the regulator in these regulations. So coming up straight to the key changes, first change as we discussed was related to disclosure of material events. There was a lot of subjectivity prior to this change. Subjectivity as in, for example, there is a Schedule A, Schedule A, Part A, Part B, etc. And there are some listed events which are deemed to be, material events, or which are deemed to be transactions, or events which are considered to be material for disclosure purposes. There some are deemed material events also, but there are cases. There was provision in which the discretion was left upon to the board of directors or the decision makers of the entity, in which if they feel that a particular event or transaction is not material enough to be disclosed with, then they were not disclosing the same. And there came the problem, and to plug this problem or to eradicate this issue, SEBI has brought in this quantification criteria for disclosure of material event, in which rule of 2 to 5% was disclosed. Rule of 2 to 5% we'll discuss later on, but if there is any 2 to 5% imprecise, 2% of your 2% of your turnover, 2% of your net worth, 2% of your 5% of your profits. So turnover, net worth and profit, these three quantification criteria were introduced. So but your turnover, profits are required to be, in case of net worth, negative net worth is required to be included for this calculation. In terms of profit, in context of profits, absolute number is required to be calculated. For example, in 1 year you are making profit of 100 rupee, in the other year you are making loss of 50 rupees, and third year you are making profit of 150 rupees. In then that case, you need to add 100, 150 and 50, that comes, that is 300 rupees is required to be considered for calculation of this 5% threshold for identification and quantification of any material events or material transactions to be eligible to be disclosed with. But here also comes the role of comparability, because you can compare apple with apple, as this concept will apply to this quantification criteria also. If there is any change or any event for which this materiality threshold is calculated, then it has to be in comparable parameter which is required. This is an harmonious interpretation of this particular regulation. It is given nowhere that you need to do in this way, but this is an harmonious interpretation. And rule of comparability also comes into play, in which if I am, for example, if I am considering any event or any transaction for disclosure purpose, and it is going to have a major impact on my net worth, for example, it is an event which is related to capital addition, or which is related to setting up any new plant or addition in plant and machinery, or any such decision which is of capital nature, which is going to impact my net worth, then I need to compare it with the net worth. If there is any change in policy, in pricing, in schemes, etc., or in my product line, which is going to have an impact on my top line, it is going to impact on the bottom line, that is profit, but it is majorly it is going to impact on the top line, then I need to compare it with the 2% average threshold, calculated with the average turnover of my entity on consolidated level. And if there is any change or any event which I'm analyzing for the purpose of disclosure, and it is going to have a major impact on the profits of the entity, then it is required that I correspond it with the 5% average profits absolute number, that is losses and profits are required to be added along with for calculation of this absolute number, and they are required to be compared with. Then there was a change which was required to be made in material amendments in materiality policy. This change was required to be implemented from last year onwards, that is post implementation, maybe 1 or 2 board meetings, many companies took this decision of implementing it within the first board meeting post the implementation of these second amendment regulations, but majorly it is done, so it is not relevant as of now to be discussed with. Then there was a major change in disclosure related timelines. So for disclosure of material events and information, you have quantified that this is the criteria basis on which a material event or information will be disclosed. If any particular event is qualifying this quantification criteria or quantification threshold, and in that case you will disclose that particular event or particular transaction, but there has to be a set timeline. So a stringent set of timelines, I would call, were introduced last year, and there were some changes which was made later on also, but still I would call it as a very stringent and transparent set of disclosure timelines, without any consideration of any holiday, without any consideration of any sort of timings for receiving of information. If it is broadly, there were 3 criteria which were introduced: 30 minutes, 12 hours, and 24 hours. 30 minutes for the disclosure timeline for any information which is required to be disclosed, which is an outcome of a board meeting. There is a slight change in this particular disclosure timeline, which we will discuss. Then the second change was related to disclosure timeline. That is, if any information is emanating within the entity, for example, if it is an internal information which is material enough to be disclosed with, then it is required to be disclosed from 12 hours calculated from the date it reaches to the person who is responsible to disseminate this information to the exchanges, for example the secretarial team. Even if it reaches to me at 10 in the night, I would say as soon as it reaches to me, the 12-hour timeline counting will start. Then the third disclosure timeline, the major change was 24 hours. If any information is emanating from outside the entity, for example, there is a change in credit rating, or there is some other external thing which is happening, but it has an impact on company's business, and it is a material event or material transaction which is required to be disclosed with, then the timeline is 24 hours from the time it reaches to the person who is responsible to disseminate it to the stock exchanges or to other regulators. Then verification of market rumors and various other communications, it has gone under a significant change post 17th of May 2024, and yet we are awaiting some sort of clarification from the exchanges, because it was a very subjective thing. You all know that in this era of social media, in this era of YouTube, in this era of other digital platforms, the dissemination of information has become very easy. Not only it has eased out, or it has mitigated, or it has bridged the gap between the availability of information with various different stakeholders, but it has posed a significant challenge also. The challenge is unverified, unverified, or without any base. There is some sort of information which is floating on the market. There may be a case that intentionally I'm a listed entity, I'm doing it, But how an investor or a stakeholder will come to know that whether it is a rumor or it is an actual information? So there was a stringent set of process which was introduced by SEBI for verification of these market rumors. Then there was some subjectivity, what will be considered rumor, what will be mainstream media. Because let me take an example. If you remember, last year SEBI penalized a very famous YouTuber for promoting in particular listed entity or in particular scheme of a listed entity on its YouTube channel, and it has caused significant losses to the investors also. So that particular YouTuber along with other persons were penalized heavily by the regulator. So we have seen many such examples. For example, I am a travel blogger, I am a food blogger, and all of a sudden I'm putting up information about any specific companies, financials, any XYZ rumor. For example, Adani is going to take over Reliance. For example, Reliance is going to take over Adani, or something is going to close. This information has come. There may be a case that these informations are correct, but there may be majorly these informations are incorrect, and they are spread with an intention to create havoc or create confusion in the mind of investors. For example, recently we have seen, though Hyundai is not was not a listed entity till today, but the Hyundai's IPO was the biggest IPO in India's capital market. So let us discuss something about that also, and what would have happened if it was an OFS by Hyundai, which will come later part to to comply with the 75% holding requirement of promoters. We have seen on the last day of that particular IPO or of offer for sale, initial public offering, there was a rumor in the market that some QIBs have invested into that particular IPO, and they have received some sort of kickbacks or some sort of other deal which is not at par with other investors or other persons who have put in their bids. And for after that, retail investors stopped applying, or they didn't apply in the same manner they were thinking to do. So was this a correct information? Probably the answer is no. Can this be considered in market rumor? Had this been a case that Hyundai was a listed entity, this would have been considered as a market rumor. And what was the following up action which is required from the company side? That the company is required to either confirm, deny, or clarify. Confirm, deny, and clarify. These are three things which a company can do about a market rumor if it is related to impending specific information. For example, if somebody says that XYZ Limited is taking over any other big company, say ABC Limited, but there is no such background, there is no such conversation which is going on within the entity, there is no such discussion which has happened, then there is no requirement of clarification, confirmation, or denial of this particular market rumor. But if there is any such background discussion, if there is any such consultation, or if there is any such process which is going on in the company, may be the case that this information would have been made public at a later stage. But now a rumor has been there in the market, the speculation is going on in the market. So in that case, confirmation, denial, or acceptance of this particular market rumor is required to be made. So as we discussed in the beginning, there were some major changes. Give me a second, please. There were some major changes which was brought in last year only, related to SEBI LODR, that is by the Second Amendment Regulation Act, which was introduced in June 2023. And then some other changes were also made in SEBI LODR regulations. So what we have seen that in some cases companies were facing some sort of practical difficulties also. In some cases, companies were facing challenges in complying with these requirements, because there was a lot of guidance which was required, a lot of ambiguity which was there. One such example I would quote, and I often quote wherever I speak or I get chance to speak on SEBI LODR, is that you see major changes related to dissemination of these informations or material events or other type of transparency related disclosures were made in regulation 30. You go to any exchange like BSE or NSE, you select any company and filter it by in the corporate announcements, filter it by type of disclosure, that is regulation 30. You will find 10, 20 or 5, 10, 20 communications made by the entity to the exchanges, but maximum number of communications out of these communications made by the entities to the exchanges are related to tax disputes. And you will wonder what type of tech disputes. If I'm a company, if I'm a bank like SDFC or SBI, I'm reporting that I have received a notice of 40,000 from GST department. I've received a notice of 10,000 from the municipality for not complying with the hygiene related requirement. I've received a notice of 20 crores, as well as I'm disclosing that I received a notice of 2,000, 20,000, 10,000 also. So whether this was the intent, the answer was no. We were continuously saying this, that the intent of regulator is to make sure that only material information is disseminated, and if any information which is material enough, if any tax dispute, litigation, penalty, fine, order, or enforcement action which is required to be disseminated, which is required to be shared with the other stakeholders, then only it is required to be shared. But unfortunately, triviality has had taken over the materiality, and we represented strongly this to the regulator from ICI side also. And a small but a welcome change was made in this particular board meeting. The change was approved. It is related to disclosure of these events based on the materiality concept. So let us discuss these 8-9 changes, and then in very brief we will discuss few of the other important changes which have come into place, such as related to BRSR, such as related to market rumors, etc. And then maybe if the time permits, we can take some of the questions, and then we'll move to the second part of this particular webinar. One such change, it is related to unified filing system. So previously, if you have worked for a listed entity, or if you have consulted any listed entity, you will see that if any entity is listed on any stock exchange, say BSE or NSE, so there are various compliances, periodic compliances, as well as event-based compliance, which are required to be made. And if any paper or any document or detail is required to be submitted, it is required to be submitted to each and every stakeholder, each and every exchange. For example, if I'm submitting any specific detail to NSE, then I need to submit it to BSE also separately. But now what proposed amendment has been approved by SEBI in the recent board meeting, which has happened on 30th of September 2024, is introduction of a unified filing system. Unified filing system means that I'll designate or I'll upload a particular compliance related document or any specific set of information on one exchange, and then it will be automatically disseminated to all other stakeholders or regulators where it is required to be shared with. So it is a welcome change. It will reduce the compliance burden, and it is a welcome change in terms of ease of doing business. Then consolidation of periodic filings. As of now, as we discussed in the first amendment, there are many filings which are related to governance. For example, quarterly corporate governance report. For example, disclosure related to related party transaction on half yearly basis. For example, disclosure related to reconciliation of share capital on at the end of each and every quarter. For example, some sort of information related to results also, financial data as well as results also. Results are required to be disseminated at the end of every quarter, at the end of every half year, and at the end of year also. So now SEBI has proposed to bring in an integrated submission platform as the unified filing system. And broadly, it will have an two type of categorization in this integrated compliance filing system. One will be related to governance. If any disclosure, any event, or any communication is related to governance related matters, for example, corporate governance reports, for example, change in KMPs or any other issues, then it will be done in the integrated filing governance part. And if it is related to any financial transaction, financial results, financial update, quarterly numbers, business updates, or any information related to road shows, con calls, etc., then it will be done in the integrated filing subsection financial. So it is also a welcome change for ease of business, ease of doing business. Then this change was proposed 2-3 months back in a consultation paper in which the industry at large has said that if any board meeting takes place after 30 minutes, after the business hours, then what was the existing disclosure norms? As I said in the beginning, SEBI has introduced in very stringent transparent disclosure timelines for various type of events, and we discussed that for any event or any information which is required to be designated, which is coming out of a board meeting, then it is required to be done in 30 minutes. So companies were facing practical difficulties in execution or in dissemination of these informations. So the proposed or the requested change was, let's give a time of 12 hours or 24 hours. But I think it is a very balanced change or amendment which has been brought or approved. That is, if any board meeting is happening after the trading hours, that is, for example, 4 p.m. or 3:35 or 4 p.m., then in that case, companies will have 3 hours time to disseminate such information to the stock exchanges. So it is a balanced as well as balanced change which has maintained the transparency part as well as eased out some sort of difficulties for the entities. Then if you have seen, or if you track the exchanges website, companies often on periodic basis, for example, quarterly, half-yearly, they do submit updates about their shareholding patterns as well as the credit ratings changes also. Now this has been proposed that it will be automated, and these shareholding patterns based on the DP accounts, etc., and backward integration will be done with the credit rating agencies, and these manual disclosures will be taken away, and an automated updation of shareholding pattern as well as these credit ratings will be done on the stock exchanges. It is also a very welcome change. Previously, the newspaper advertisement for financial results was mandatory. Now companies are no longer required to publish the results in newspapers. Often, if you read any business newspaper, Financial Times, Economic Times, Business Standards, or any other newspaper, in result season which is going on, we see companies do publish their financial results in Hindi newspaper or in a regional newspaper or in an English circulation based newspaper. So now this is proposed to be made an optional requirement to publish these financial results in the newspaper, and it is also very welcome change, because in the changed era of digital reach, digital outreach, and digital world, when the AGMs are allowed to be held through the digital mode or through the web conferencing mode, then we don't feel that there is as such need of publishing these results in the newspapers, because these are very well aware on social media, on other type of digital platforms, and we all have access of data through our cell phones as well as our computing devices also. Then the next change, which we discussed, I told that from the beginning itself, we are saying that this timeline for litigation and dispute disclosure as well as the amount of penalty and fine, these all three changes are correlated to each other. Why it is important? For example, you will see post this change being implemented maybe in a year, in a month or so, you will see in regulation 30, you will see many sort of litigation and dispute related communications are disseminated to the stock exchanges. For example, I am a listed entity and receive that there is a litigation which is being filed by an entity on me, and I'm a listed entity, or there is a dispute which has taken place in a statutory department as well as within with other stakeholder also, and I was required, because this information falls into the category of we discussed 30 minutes, 12 hours, and 24 hours. 30 minutes board meeting, 12 hours emanating within the entity, 24 hours if any information is emanating from outside the entity. And there is no such materiality concept which was there for litigations, disputes, penalties, tax related issues. So now the timeline has been eased out and extended to 72 hours. So the companies have an extended time of 72 hours to designate such information. Why it is important? First, prerequisite of this extended timeline is that you need to maintain such information in your structured digital database, SDD. Then if the information is maintained in SDD, then you are having an extended time of 72 hours to evaluate, to analyze, and to make sure that if you are disseminating or if you are sharing any information with other stakeholder, it is material enough to be shared, and it qualifies the materiality threshold also. Then the next change is related to tax litigation. As I discussed in the beginning, it is I think one of the most one of the most misunderstood change which was brought in last year by the SEBI, and you will see n number of communications made from the listed entities regarding these tax disputes or tax litigations. I am designating each and every information, and triviality is taking over materiality is one issue. The other issue is that there is a concept of disclosure of continuing event or information. So as soon as if I am disclosing any tax litigation and considering it as a material event or information which is required to be disclosed to the exchange and disseminating it simultaneously becomes a continuing event also. So all major all major steps or events, or I would say milestones of that particular dispute litigation is required to be updated, uploaded, or disseminated to the exchanges. So now SEBI has proposed in principle that let's disclose these tax litigation based on materiality. If there is any fine penalty, then previously there was no settled law. Regulations say, if you read it in letter and spirit, you will understand that it meant that all fines and penalties, irrespective of the amount, were required to be disclosed. Now there is a change which is introduced, and it is a very welcome change, that if it is on account of a penalty fine imposed by a sectoral regulator, for example, if a RBI is imposing any sort of fine or penalty on a bank, for IRDA is imposing any sort of fine penalty on an insurance company, or RBI is imposing fine penalty on an NBFC, then it becomes a penalty fine which is imposed by a sectoral regulator. It is the threshold is 1 lakh rupee. If it is an action by any enforcement agency like ED, CBI, SFIO, or any other enforcement agency, then the threshold is rupees 1 lakh. And if it is from other any regulator, for example, Competition Commission, for example, some sort of pollution board, for example, some tax department or other regulator, then the threshold is 10 lakh rupees. If that particular fine penalty is over and above the threshold of 10 lakh rupees, then it is required to be disclosed with. Now, coming up to the last few changes which were introduced, then SEBI has proposed to provide, in principally approved, additional time period of 3 months to fill up the vacancies of various committees as well as KMPs if the company is coming out of insolvency plan, that is CIRP. What is the brief existing disclosure related norms? There are certain set of disclosure requirements. Generally, it is the timeline is 3 months. If it is a normal case, then the company is required to fill in such vacancy within 3 months of the particular position being vacant, for appointment of KMP, CFOs, board of directors, independent directors, etc. For PSUs or any such entity which requires any sort of specific statutory approval, which requires any sort of approval of a particular regulator for appointment of any, for example, independent director per se, or for example, filling up the vacancies of KMPs, then the timeline is 6 months, as well as the time taken for such specific approval from the regulator as well as other ministry, etc., will be excluded from counting of that particular timeline of 6 months. Now, the other change, which was very well discussed, but I feel personally, it is my personal opinion that this requires and reconsideration from the regulator. This change is related to prohibition of insider trading. SEBI has expanded the definition of person deemed to be connected person, in which they introduce initially or propose that a firm or its partner or its employee in which the connected person is also a partner will be considered as and deemed to be connected person. Now, to naked eye, it seems that there is no problem, but there is a problem. For example, I am a connected person and I am partner in XYZ firm or XYZ Limited or XYZ LLP. Then by this virtue that I am a connected person in ABC Limited, all the partners or employees, they have not defined that only KMPs are included. I think probably a clarification or guidance will work. But all employees will fall into this particular deemed to be connected person criteria. And this is not doable. The data will be so used that it will not be possible for the companies to collate and designate correct information to the regulator. And I think this is not the intent also. So maybe a separate guidance or clarification will come, in which probably they will say that the employees means that KMPs or the persons who are at the decision making level, so they are able to have an impact or effect on or take out the benefit of any insider trading, any UPSI and unpublished price sensitive information. And the other change is related to if any person is sharing household or residence with a connected person. For example, I am a connected person in ABC Limited. Anybody who is sharing the same household with me will be considered as an connected, deemed to be connected person, be it my in this case, be it my if any servant is even living in my house, my spouse, my father, mother, my brother, anybody who is living in the same household or sharing the same residence will be deemed to be a connected person. Then the other change which was proposed and which is considered by the SEBI for SEBI board for in principally approving the same is related to inclusion of not only relatives but expanding the definition including immediate relatives in the definition of relative to mean a connected person. Then spouse of person, parent of the spouse person, the parent of the spouses, it is in line with the family tree which is given in the income tax also. Probably you can correlate it with that. Then sibling of the persons, a sibling of its spouses, child of the person and child of its spouses, spouse of the person listed at point number 3 and point number 4. So these are the few changes, 10, 11 changes related to SEBI LODR. I am only discuss the changes which are related to SEBI LODR, which were introduced by which were approved in principle by the board, and the notification will come in maybe a month or 2 months or so. But in principle they are approved, and separate notification will be floated by the regulator. So I think we are sitting at 3:53. So if there are any question, Utsav, we can take those questions, because if you ask me to continue, we can continue till 5 also, but I would feel that it is not in the best interest of other speaker as well as the time. So let's take some questions which are there, and then we can hand over the baton to the other speaker, Mohit ji.
So yeah, coming from your presentation only, it was really deliberate, and you deep dived into the complete regulation. There is a question in my mind which is regarding the rumors that are being spread by the influencers, and does it also tantamounts to the insider trading that we talk of?
See, insider trading and the rumor are two different as well as connected things. First, we need to understand what is mainstream media. So SEBI has defined that if any information which is floated or which is there in the mainstream media will only be considered to be, analyzed for whether it is a rumor or not. So first, my channel or whatever social media we are talking about, influencers, if it is an platform of such stature that it can have an impact on companies financial,
We get to see that there are a lot of investment advisors nowadays which are coming on various channels like YouTube and Instagram and various other stories that they post, and they talk about few companies which are going to be very high in pitching in the share prices. So in such cases, how do you see that? Like, how does SEBI regulate them, and how does SEBI sees that as a part of insider trading?
So, see, I think we need to separate this issue from the insider trading related issue. If I'm not wrong, you are talking about the recent debacles or recent issues which have happened around these influencers, in which, you know,
Certainly.
through Telegram channels, through YouTube channels, they are advising investors to buy a certain stock, and on the other hand, they were selling that stock, or they were interrelated with the companies. So your issue or concern which you have raised has already been addressed by the SEBI. SEBI is, you know, under consideration for preparation of a detailed. They have issued some sort of preliminary guidelines, but they are preparing a detailed regulation for these influencers, I would say. And after which, even if in the present stage also, only those persons who are registered with SEBI as an, you know, investment advisors are allowed to share their views on a particular stock or script, etc. But post implementation of these specific guidelines, your specific concern is already being taken care of, and SEBI is coming out hard on these things, and only verified, vetted, as well as information which is substantiated with specific documents or background material will be able they will be able to share it with the viewers also. So I think two takeaways from this: one, you need to be a registered investment advisor with SEBI to share these information or any sort of financial advice or any sort of buying guide, etc. on any stock or any script. And second is, if you are sharing it, it has to be backed by proper research as well as proper documentation.
There's another question that comes to my mind, that for the non-compliances, how does the SEBI monitor the compliance of this regulation in particular, and the consequences of non-compliances after it?
See, there is a very robust, you know, mechanism which is there for monitoring of these any sort of non-compliance. As we discussed in the beginning, exchange is the only place where any sort of information is disseminated to other stakeholders. So SEBI also takes out information from there only, but there is a very robust mechanism in which it may be case that suo motu SEBI is taking up any case. There may be a case it is based on any complaint. For example, you, me, or Mohitji, they feel that this company is not doing right, and they lodge a complaint with the regulator. It may be a case the matter is referred by exchanges also. So there are 3-4 modes through which SEBI regulates. There is a case. There are two different type of. Mohitji, please correct me if I'm wrong, because I'm not much into these adjudication or other proceedings. So there are adjudication proceedings. There are certain sort of offenses, or I would say, you know, events which requires adjudication. So it is a separate set of, you know, quasi judicial process which is there. And on other front, SEBI has defined some sort of monetary penalties also, which ranges from 5,000 rupees or 5,000 rupees a day to 25 lakh rupees or a crore rupee also. So there are two type of adjudication processing. There are two type of monitoring mechanism which is there. One is adjudication proceedings, which are required for certain defaults or certain type of you know, non-compliances, and on the other part there are some sort of monetary thresholds which are there for various fines and penalties.
All right. So thank you so much, Kuldeep. With this, I close the session for the question and answer round. Thank you so much for a detailed deliberation on LODRs.
Thank you.
With this, I would like to take the session forward, where I would like to introduce our second speaker for the day, CA Mohit Basir. We welcome you, Mohit.
Thank you, sir.
Mohit now. Mohit is an associate member of ICAI, qualified in the year of 2012. He's an experienced professional with over 10 years of experience in equity and capital market. He was associated with reputed investment banks such as JM Financials, IDFC Securities, and has involved multiple prominent capital market transactions across sectors. He is also nominated member for Financial Market and Investors Protection Committee of WIRC of the ICAI. We welcome you, Mohit, and the baton is on to you now. Please take us through the capital markets, the IPOs, and the sought after session. Thank you so much. Please begin your presentation.
Sure. Thank you, sir. Thanks for the introduction. Pleasure connecting with all the members as usual. I'll just share my screen. The topic for today's session is understanding the IPOs, but specifically from the glasses of a beginner or a professional or from an investor. So I have, broken my I've made my presentation in such a way so um, you know even a basic beginner who wants to understand about capital markets or IPOs does get help from this session. So that is the idea. Uh, of course, some of this material and a very fair disclaimer that some of the material would have been, taken from publicly available websites. That could be SEBI, stock exchanges, or the depositories, etc. An IPO, in an essence, is a initial public offer. Okay, and when we say a public offer, the first question comes to anybody's mind as a beginner. Okay, is what is a public issue then? Now, in India, the public issues are governed by SEBI. My fellow Kuldeep was talking on SEBI LODR regulations before that. One of the listing and disclosure requirements regulation applicable on the publicly listed companies. So a publicly listed companies can have 4 kind of public issues in India currently. One of them being sorry. The public issue, rights issue, bonus issue, and private placement. Technically, only public issue, which is IPO and FPO, qualifies in the category of public issue. Rights issue, bonus issue, private placement are specifically issued to a set of shareholders. If we break down public issue, there are 2 types of public issues: IPO and FPO. IPO is initial public offer, and FPO is further public offer. Initial public offer is when a company is coming onto the stock exchanges for the first time. All of you must have heard about, when you invest in an IPO, these 2 terms of fresh issue and offer for sale. When a company comes with an IPO through a public issue and do a fresh issue, that means the company is now issuing fresh shares out of its capital, and the money for the shares that are being issued through fresh issue goes to company, is the fresh issue part. And the offer for sale is when the existing shareholders of the company offer their shares through the IPO to the new public shareholders. That part of the offer is an offer for sale. So for example, let's say you saw Hyundai IPO getting listed today. It was a complete OFS. In a public issue, the issue can be made a hybrid issue, which is some part of the issue can be fresh offer and some part of it can be through offer for sale. It could be 100% fresh issue, or it could be 100% offer for sale. So as I said, Hyundai was a 100% offer for sale, where either the promoter or the selling shareholders of the company sold their shares through the public issue to new shareholders. So company really didn't get anything out of it except the benefit of getting its shares listed on the stock exchanges. That's IPO for you, fresh issue and offer for sale. Similarly, when a publicly listed company on stock exchanges do a further raise through a public issue process, that will be called a follow-on public offer or a further public offer. Again, that can also be done through fresh issue or an OFS. Other than these 2 modes of public issue, how can a listed company raise funds is one could be a rights issue. In case of a rights issue, as probably you all are aware, is this company issues a letter of offer to the existing shareholders, giving them a chance at a probably discounted market rate from its current market rate CMP giving a chance for the existing shareholders to be part of the rights issue and take further shares in the company in a predetermined eligible ratio or a entitlement ratio, I would call it, and put in additional money to the company and take those shares away. That's rights issue. Why it is called rights issue is because the first right is given to the existing shareholders of the company. In case of bonus issue, company don't raise fresh funds. Rather, it's a mechanism to uh, reward the shareholders, existing shareholders of the company. The one way could be dividend, and but taxation perspective, probably bonus issue helps company to liquidate, to get a better liquidity in case in the shares of the company, and the existing shareholders get additional shares. There is another way of raising funds by a publicly listed company in India, which is private placement. When I say private placement, that means the shares are offered to only a particular set of investors by the board of directors of the company, which can again be broken into two parts of preferential issue and a QIB qualified institutional placement. Preferential issue is or qualified institutional placement is when the company when they feel the need of funds reaches out to the individual investors or QIB investors for some money, and those allotments are done at a price which are again governed by SEBI ICDR regulation. All these issues that we are talking about here are governed by a regulation called SEBI ICDR regulation, SEBI issue of capital and disclosure requirement regulation. That's probably the most exhaustive regulation we have on capital markets in India. Moving ahead, as I said, I've just explained these IPO, FPO rights issue in detail. I don't think we have missed. Again, in rights issue, the entitlement is done on a particular record date, similarly like a bonus issue, similarly for preferential and QIB. Okay, now what is the question which first comes to your mind when we talk about an IPO, that which is a company and how it is eligible for an IPO. In India, if you see the IPO market, I'm sure most of the members must be participating in an IPO and must have heard of something called main board IPOs and SME IPO. In case of I'll talk about differences between SME IPO and main board IPO, but probably I would like to touch base upon what are the eligibility criteria for main board IPOs in India. Right. So for eligibility criteria, if you see, for a main board company, there are two regulations within SEBI ICDR regulations, is regulation 6.1 and 6.2. The broader difference between these two regulations is that profit-making companies can come under regulation 6.1, and non-profit making companies like Paytm, Zomato, they did their IPOs under regulation 6. So now, again, as a layman or for a beginner, what is the difference between regulation 6.1 and 6.2, which is what is here. For any profit-making company, there is a minimum track record criteria, which is provided by SEBI, is any company which has net tangible assets of at least 3 crore rupees in preceding full financial 3 years of 12 months each, they are eligible. Okay. But out of the 3 crore tangible asset that they have shown in their consolidated financial statements, not more than 50% of that should be in terms of monetary assets. When we talk about monetary assets, that is more like cash and bank balance of the company. The idea is if a company has more than 50% of its net tangible asset in monetary cash, then probably they don't need an IPO to come up with, right? This particular criteria does not apply if a company is doing an IPO through only offer for sale, because anyways through offer for sale IPOs, the money doesn't come to the company. So company cannot do a fresh issue if they have more than 50% of their net tangible asset in form of cash and bank balances. This is the first condition. The other condition, and all of these conditions shall be met. It is there is no or here in between. All of these conditions shall be met before a company gets eligible to do an IPO under Regulation 6(1). The second criteria, which is the most important and the difficult criteria here, is any company looking to go for an IPO in main boards has to have a net operating consolidated profit before tax has to be at least 15 crore of average in last 3 financial year, and they cannot have a negative operating profit in any of those years. So let's say if a company, A has a net operating profit of, let's say, 20 crores in FY24, uh, 20 crores in FY23, and let's say 10 crore in FY22. So the total being 50 crores, they qualify for this criteria. But let's say if a company B, which has a net operating profit of 30 crores in 24, 50 crores in 23, and a loss of, let's say, 2 crores in FY22. So the net total would be 48 crores. But since they have a negative operating profit in FY22, they will not be eligible to come for an IPO under these regulations. The other criteria is to have at least 1 crore rupees of net worth, and which probably is generally the easiest criteria. Any company coming for a main board IPO would qualify for this criteria. And the other condition is if a company has changed its name in last 1 year, at least 50% of the revenue should come from the activity which was indicated by the new name. If it was just a name change and no activity was indicated, this probably criteria is not applicable in that case. So if any company which fulfills all of these criteria, they are eligible to do an IPO under Regulation 6(1) of the SEBI ICDR regulation. Under the difference between Regulation 6(1) IPO and 6(2) IPO, you would see is the allocation difference. If you see the slide here, the companies with track record can issue its shares. 35%, those companies has to allocate a portion of at least 35% to the retail investors portion, because these companies are profitable companies, good companies from the eyes of SEBI, and hence they will have to allocate the higher portion to retail investors. See, the bottom line for any regulator in India is to protect the retail investors and the public investors. And when they think that any company which is meeting their profitability track record criteria, they want those companies to allocate a higher share of their IPO portion to the retail shareholders. And hence 6(1) criteria, which is for the profitable companies, at least 35% of the IPO size has to be reserved for retail investors, individual investors, people who invest below 2 lakh rupees amount. That's retail investors for you. At least 15% to non-institutional investors. In a layman term, we call them HNIs. A 15% of the portion shall be restricted for those people at least. And not more than 50% to QIBs. Now, QIBs are qualified institutional buyers. A few of them could be, your FPIs, your mutual fund, pension funds, any NBFC, systematically important NBFC, which is more than 500 crore net worth, are also forming part of QIB. So supposedly from SEBI's end, in understanding the perception is these QIBs are better informed investors. But since the company is profit making and eligible to through these profit making track record criteria, they still want to give less allocation to QIBs and higher allocation to retail investors. On the other way around, if you see right on the right side, right corner of this slide, companies which are not making this track record criteria and they cannot make their IPO under Regulation 6(1) has to come within Regulation 6(2). In that case, at least 75% of the IPO has to go to QIB. If the company is not eligible, if the company is not able to garner 75% of its IPO from QIB, the issue cannot go through. These companies are loss making, or at least not profit making, from SEBI's criteria, and supposedly a more riskier investment, and hence the retail investor shall probably is discouraged to be part of this IPO, and a very lower kitty of maximum 10% is allocated for such IPO in to retail investors. For HNI, it does not change. 15% can go to HNI, and at least 75% of the reservation shall go to QIBs. That is the main board criteria for SEBI. Similarly, there are SME IPOs. If you see in market, of course, talk of the town currently. The difference between, if you see the eligibility criteria on this slide, I have not mentioned anything about stock exchanges, because again, the major difference is, in case of a main board company or a SME company, main board companies will get listed on both stock exchanges in India, BSE and NSE. In case of a SME IPO, you can only pick one. The companies have to pick one exchange to get listed. So any SME company either will get listed on NSE or BSE, unlike main board IPO where it will get listed on both stock exchanges. That is the first difference. The other difference is, and before making any investment, you should be aware the SME IPOs are approved by stock exchanges. SEBI does not review the SME IPO currently. The process for an SME IPO is you file the application with stock exchanges. One of the stock exchanges, the stock exchange will approve, and then the final offer document will go to SEBI only for records. SEBI is governing these IPOs but are not reviewing the SME IPO, and hence it is perceived to be a more riskier investment compared to main board, where the IPO has gone through the lenses of SEBI directly and not through just stock exchanges. So that is one bigger difference. At times people ask this question, what is there any difference between the trading time? So there is no trading time difference, but there is a difference in trading, which is the lot size. In case of an SME IPO, an investor can only deal in a lot size of at least 1 lakh rupees and forward. In case of a main board, the lot size is generally 1 share. You can buy 1 share of Reliance, but you cannot buy 1 share of a SME listed company. You will have to trade those shares in the lot which is currently in place. The lot sizes changes depending upon the movement to the price. However, they don't increase the lot size. The lot size cannot be more than the lot size which was prevailing at the time of IPO. The lot size though reduces over the time if the price of that particular security increases. So these are some major differences between SME IPOs in main board IPOs. Of course, eligibility criteria are also different, and here we are on the eligibility criteria for both exchanges, BSE and BSE SME and NSE Emerge. The platform of BSE for SME is called BSE SME, and the platform of NSE for SME companies is called NSE Emerge. Both these platforms were introduced in the year of 2012 when government felt that there is a need for SME company to have more avenues to raise funds through capital markets and not just rely on external fundings of banks or promoters' own money, etc. So because bank funding has, of course, some limit for any company to go with, not in considering the asset light companies model, the technology companies which are now we are seeing on the rise, they don't have collaterals to offer to banks, and therefore a need was felt that the Ministry of Finance and exchanges felt that there is a need for SME exchange. The SME exchanges were introduced in 2012. The initial few years were a bit lull period, but as we can see, last few years has been good for these stock exchanges, and a lot of companies are now coming forward to list their company. And why is so that a lot of companies are coming? The primary reason is the eligibility criteria. The eligibility criteria comparatively is much easier. The one deterrent to list your company or any company on SME exchanges is the paid up capital. If any company which has paid up capital of more than 25 crores, they cannot raise funds through an SME IPO. They will have to compulsorily go and get listed their company on main board through the main board IPO. So, and that it is only 25 crore paid up capital and not 25 crore net worth or 25 crore anything. Your face value multiplied by the number of shares that you have is your paid up capital. Reserves are not considered while talking about this criteria. So your paid up capital should not be more than 25 crores. In case of BSE SME, the net worth has to be at least 1 crore rupees in last two preceding full financial year. In case of an NSE IMT, irrespective of the net worth amount, it just have to be positive net worth and you are eligible for NSE IMT IPO. BSE has an additional criteria in terms of net tangible asset. If any company which has net tangible asset of at least 3 crores in the last preceding full financial year, they will have to meet this condition. The 15 crore average net operating profit criteria that we saw on main board is only very relaxed here in case of SME. It says if any company has a positive EBITDA in last 2 years out of 3 years are eligible for both exchanges, NSE and BSE. So they have not put a number criteria here because 15 crore net operating profit is a very big number. And hence they have not put a criteria of any number. Even if you are making a crore rupee of profit, okay, your EBITDA is positive in last 2 years out of last 3 years, you're good to go ahead with. However, BSE has kept it a bit tricky, where they say not just any 2 years out of 3 years, you will also have to be EBITDA positive in the last financial year. So your last financial year has to be positive, and then the 2 years before that, any one is positive, you are okay to go ahead with an IPO for an SME exchange on BSE. There is another additional condition by BSE, which is the leverage ratio. If any company which has a more than 3:1 leverage ratio, they are not eligible to make an IPO on BSE SME exchanges. And the last criteria, which is again last important criteria, which is again similar for both stock exchanges, is any company which is coming for an SME IPO, it could be through conversion from a proprietorship firm or a partnership firm or an LLP, has to have a track record of at least 3 years. Any company, you cannot make a company today complete 1 year and then go for an IPO, show some profits and go for an IPO. The track record at least of 3 years for any businesses before they come on an SME IPO is mandatory for an SME IPO. So these are some basic eligibility criteria for any company to go ahead on for an IPO. It could be main board or a SME IPO. Now, what is the life cycle for an IPO process overview? I've broken down the process in terms of, we all see one side of IPOs is when the IPO gets launched, we apply an IPO, and then, whether the allotment comes or not, we feel happy or sad and get ahead with life with another IPO. But what happens in the background of those such IPOs is something that I tried to cover in 4 stages. The first step is a preparatory stage. Once a company has reached out to a merchant banker, the most important intermediary in an IPO process for a company is a merchant banker, right? So first the company appoints a merchant banker, sets up the data room. Now, if you see the IPO process, okay, the most important part again in this whole IPO process is a book called draft offer document, which is prepared for approval from stock exchanges or SEBI in case of a main board IPO. So this whole process is first driven towards making that offer document. Okay, we'll talk about that offer document probably a bit later in this stage. So first, the appointment of merchant banker sets up data room, appoint more intermediaries. So who all are other intermediaries in an IPO is your legal counsel, your BRLM, your registrar, your statutory auditor. So appoint all those intermediaries, start the diligence process. BRLMs, counsels, and auditors do their diligence. Once the diligence is done and restated financials are done from the auditors, again, we'll talk about restated financials later in the this presentation. All those legal agreements are driven, and then DRHP is prepared. Now, the DRHP has probably, if I have to sum up in one line, the DRHP has information about the past, present, and future of company, its business, its directors, its promoters, its capital structure, its industry, everything. So everything that you can think about a company, the draft offer document has some details about it in the offer document. The draft document offer document, once prepared, is submitted to stock exchanges and SEBI for their approval. Once the stock exchanges approval comes in the name of in principle approval, of course, exchanges and SEBI does their thorough review of the offer document. They ask questions to merchant bankers, legal counsel, and the company about the disclosures that they made. They take clarification as a public shareholders, and again, it's a very common practice but not known. Any offer document is open for at least 21 days for public comments also. Nobody provides, unfortunately. Okay, but any company, anyone in public, people like us, can make any comments on the offer document and write it to exchanges or SEBI, that okay, these are our comments, you should look at these comments as well. Unfortunately, we as investors are not so proactive. I've been part of multiple IPO. I have never seen any public comments coming onto those offer document. So exchanges in SEBI reviews the offer document. They ask, clarify on whatever point that they feel. It could be on business, history of promoters, director. The answers are given by the BRLMs. BRLMs is your book running lead manager. Again, a very a very technical term used for a merchant banker. So merchant banker lead manager, book running lead manager is the same term that we use for a merchant banker here. The questions are given, and then those responses are filed by BRLM. So if satisfied by SEBI and exchanges, they give their final okay, that okay, you are okay to go ahead with an IPO. And once you receive an okay, any company can open their IPO within 1 year from receiving the okay from stock exchanges SEBI. The company moves ahead, file a final offer document with ROC. Of course, this is done in the final stage. And one important stage, which is the third stage of marketing the IPO, is in between. In between filing of DRHP, when the approval process also goes on, the company and its management with the merchant bankers goes on roadshows, talk to investors, take some feedback about how the pricing should be done for an IPO, takes the investor feedback, and basis that the issue pricing is decided कि चलिए क्या price पे IPO करना, what should be the valuation of the company, right? And then of course final offer document is filed with ROC, and that's when layman people like us gets to know कि अच्छा चलिए IPO आ रहा है, we have to invest in this IPO. Once the IPO opens, of course, for day 1, 2, 3, or it could get extended for another 1 day, 3 days, depending upon the issue subscription. So the final offer document is filed with ROC against SEBI and stock exchanges after taking their comments in the earlier book. Final offer document, issue open, issue close, and then credit of shares happen. Your money gets debited if you are lucky and gets allotted. The money gets debited in your account, credited to the company or the selling shareholders account, and the share starts getting listed. Earlier, it used to be T plus 12 days, T plus 6 days. Now, in T plus 3 days, third day from the IPO closing, the shares gets listed on the stock exchanges and traded ultimately. So while I have tried to summarize this in one form, it takes months uh, and sometimes few years time, depending upon the company and its situation. But at least, you know, if you take at least bare minimum, a main board IPO takes around 5 to 6 months kind of a timeline just to prepare the DRHP and then file. So in a nutshell, probably 7 to 9 months kind of a time on a bare minimum to complete a main board IPO, wherein in SME probably it takes around 6 months time to get the IPO done from end to end. So this much time is taken for the process that we spoke about here. Um, who are key agencies in an IPO? I tried to cover that in the previous slide itself. The BRLM, which is the merchant banker, does the due diligence and overall coordination for the IPO. Legal counsel. In case of main board IPO, there are multiple legal counsels, domestic legal counsels, and international legal counsels, because these main board companies also go on marketing the IPO to foreign destinations like US, Singapore, Hong Kong, UK, etc., etc. So there is a need for those companies to follow the laws of those international jurisdictions as well. So domestic legal counsels, international legal counsels, auditors, of course, play a big part in IPO. The registrar is the one who controls the dematerialization of shares and the registry work after the IPO is listed. Advertising and PR agencies takes care of the marketing and the statutory advertisements which are required for an IPO. The printers are there to print the form and the offer document. There is also industry consultant which prepares an industry report on behalf of company to talk about the industry of the company. Sponsor bank and bankers to the issue. Again, a couple of these consultants are uh, behind the curtain for us to not see. But when you apply in an IPO through UPI, you get a message for blocking and blocking, etc. So that is done by sponsor bank through the help of NPCI. In case of any company who's doing an IPO of at least 100 crore fresh issue, they have to compulsorily appoint a monitoring agency. In India, only credit rating agencies can be um, a monitoring agency. So they monitor how the money is used by the company after the IPO. So they technically basically checks whether the whatever the money that the company written in the offer document, that okay, this is my objects of the offer and how this is how I'm going to utilize this money. The monitoring agency's job is to ensure the money is utilized for the purpose that they stated for. Um, Quickly moving, a role of a CFO in case of a company, a lot of professionals who are hearing must be, working in an industry environment. A CFO and CS, to be honest, plays a very huge role in case of an IPO. Whenever we have dealt with an IPO company, and I've been, part of few merchant banking firms before I started my own IPO advisory firm. CFO and CS plays the largest role after a promoter. Probably promoter is the decision maker, but it is the CFO and CS who drives the process. Now, as a CFO, he is a key member of the team. All the business plan, financial related activities are driven by the CFO. What is going to be the business strategy and financial requirement of how to present that in offer document, the objects offer, how the money is going to utilize for is again driven by the CFO and teams. He again is a key member to be the coordinator between the auditor uh, to prepare the financial requirements to be done in offer document. He also, again, a CFO is the biggest intermediary between the company and the merchant banker. Uh, uh, Along with the company secretary, probably takes care of the diligence on the financial side, and company secretary takes care of the diligence side on the secretarial side. Uh, when we go on road shows to market, investors ask specific questions to the CFO on the business, and probably CFO is the best person to answer those finance related questions. So my probably advice here could be to professionals who are involved in their company. If you get a chance to be a part of an IPO process, it's a huge learning curve, to be honest, because the IPO itself is a project, okay, going for a few months. There is, as I shown you in the slides before this, there are a lot of intermediaries involved. So it's a learning process because the stakes are very high. There's always a pressure situation when the IPO is going on. So you as a professional will have to manage your day-to-day operations of whatever you are doing in the company as a finance professional. That will go on, but at the same time you will have to deal with multiple intermediaries, and all these intermediaries are expert in their own work, right? So dealing with those intermediaries gives you another perspective about how things works in their domain, and it probably, as I said, enhance work as a huge learning curve for an individual. A very good learning curve because of a pressure situation and multiple intermediaries that you're going to deal with. If you get a chance, it's a good opportunity to have even on your resume. Now, since we spoke about the role of CFO, it's my duty again to talk about what it is there for members like me who are in CA practice. As a CA, if you are in a practicing environment and if you get a chance to work in an IPO, there are multiple things that you can do to help any company who is coming for an IPO, any of your clients where you are auditors. If they're looking to do an IPO, there are a few things that you can do. Okay, you can do end-to-end support. See, if you see a lot of companies in India, they depend heavily on practicing chartered accountants or their auditor. Could be there is anything most of the time on when you speak about financials to company, and the answer from promoter would be, I'll speak to my auditor and let you know. In the initial stages of the companies, the chartered accountants were also helping the companies with the compliance. It could be even the company secretary roles of the company secretary function, right? So a chartered accountant, a practicing chartered accountant who's associated with the company is probably the best placed person to help a company in their IPO process and be the bridge between the company and all these intermediaries that will get appointed later. It could be the merchant banker, legal counsel, to supply the information, because see, most of the time the company teams are not self-sufficient to do this work, and hence provides a good opportunity for practicing chartered accountants like us to be part of that project and help the company and make a living. Of course, assistant to merchant bankers and company in conducting the financial and other due diligence requirement for the IPO. That's our core business to be in. So that comes to us, by default. Restated financials. Again, I'll discuss this restated financial in detail later part of the presentation. And of course, there are a lot of certifications required in an IPO process, which can only be given by a peer-reviewed CA. So if you really want to work in an IPO environment, my suggestion would be to first get a peer review done. Most of these IPO companies or legal counsels or merchant bankers, or even the regulators, the first thing that they ask in an IPO environment, whatever the certification or financial statement that you have got, whether they are done by a peer review. Even the LODR regulation very clearly says any listed company can be audited by only peer reviewed chartered accountants. SEBI ICDR regulations very clearly state restated financials can only be prepared by peer reviewed financial auditors. So anything, if you're looking to get active in this scenario as a professional, my suggestion would be to first get a peer review done, because that's a precursor to be associated with this industry. Yeah, so this is the IPO management work that I was talking about. As a CA, we are probably the best placed person to be the bridge between the merchant bankers and the legal counsels. We can ensure timeline management, we can ensure data exchange in the most efficient way. We can keep the stakeholders involved on how the project is going, whether there are any timeline lapses, etc., and do the financial diligence. So this is quite a unique opportunity. And as I said, we are the best suited and best placed for the job. Now, restated financial statements, if you look in any offer document, those companies present their financial statements in an offer document in a certain way. Now, certain way means restated financial statements. Every company gets their financial statements audited in a year. Okay, but SEBI ICDR regulation very clearly states an IPO company has to provide not only just last 1 year financial or 2 years financial, they will have to provide at least 3 years financials in the offer document. And again, those 3 year financial has to be in a columnar manner of 1, 2, 3. Unlike our audited financial statements, which is 2 column, a restated financial statements has to be at least 3 columnar and can be for 4 columnar. Now, all of these restated financial statements, as I said, very importantly in the first point here is the peer review. You have to be a peer review chartered accountant to sign these restated financial statements. Again, a very technical point is if any company is coming for an IPO is filing their offer document, whatever the financials that they are presenting in the offer document cannot be older than 6 months. So let's assume a company is filing its offer document to the stock exchanges on 31st August. Can they file 31st March 24, 23, 22 financials in the offer document, and is it okay? Yes, because the last period that they are presenting in offer document is 31st March 2024. They are filing in 31st August. It is within the 6 months period of from 31st March 2024. But can a company who's filing the offer document on October 15, can they only file FY 22, 23, 24? No, because the last date of financials is 31st March. You're beyond 6 months time, which is 30th September. So the company has to now get an audit done for June or September, August, July, whatever it is. But on the date that you file the offer document, the financial information present in the offer document cannot be more older than 6 months. So, and if you're doing, let's say, if you're filing in 15th October, if you're presenting August numbers or June numbers, let's say, so your financials will be a 4 columnar now, FY 22, 23, 24, and then June 24 quarter. Again, idea is very simple. When you are going to make a financial investments decision basis the offer document information, the financial information presented in offer document, you have the latest possible information available with you, right? And hence the 6 month thing. Now, in case of if a company is going for an IPO and presenting its IPO to US investors also, then the requirement is 135 days. So if a company is filing IPO, let's say beyond 12th August, they cannot do they will have to do a June audit or a May audit or an April audit. So the 6 months rule changes by 135 day in case they are doing their IPO under regulation 144A. Now, again, I said restated financials here a lot of times. So the question could be, what is it, what is restated financial statements? So the restated financial statements means nothing but it is reformatted accounts in a way that all the previous year's financials. So let's say if we are sitting in October 24, FY 22 financials also has to be restated the way my current financial year financials are being presented. So let's say if I used to follow policy X to make my accounts in FY 22-23, I am following a policy Y today to make my financial statements. So all of my FY 22-23 financial has to be restated by this peer reviewed auditor, which could be statutory auditor or any other auditor, has to restate my older financial statements with the applicable policy Y, so that all the historical financial statements which are presented in the offer document are comparable for the investors, because I cannot present FY 24 financials with policy Y which are not comparable to FY. How would an investor do a financial review of those financial statements and make their investment decision? That's the idea. Then there are, other than this, of course, there are comfort letters and multiple circle of exercise and certificate exercise which are done by the auditors. Other than this, so I'm moving ahead from the what. So I tried to cover what as a CA if you are in industry, what you can do in an IP environment, what you can do if you are in practice. There are multiple avenues available for practicing CAs in India to offer their services to an IPO companies or companies which are under IPO already. There is another term that you would have heard, although not relevant, is a book building in a fixed price IPO. Fixed price IPOs are dying most of the time, but see, understand in case of, let's say, for example, Hyundai IPO, a lot of people would have, spoke about, why don't we apply on a lower price band? So in case of a book building IPO, the company gives you an option to bid within a price band. Though, it's a very hypothetical situation in India, we all of us apply at a higher band because we all know the issue will get subscribed somehow or other. And the higher band is also the cutoff price. So a fixed price IPO, IPO where companies fix the price, you will have to bid at that price. In a build IPO, you hypothetically get a chance to bid at a price that you like within that price. That price band has to be at the higher. Again, a very technical term. The difference between the higher price band and the lower price band has to be at least 5%, and the maximum difference can be of 20%. How to apply in an IPO? I think all of us know there are 3 processes. There is something called ASBA process, application supported by blocked amount, where your money is gets blocked within, it remains in your bank account, but gets blocked once you apply for an IPO. You can do it through a filled form, submit that to your broker, put in just your bank account number. The broker will then send that form to your bank in which you have the bank account for blocking the money. You can apply through UPI, very easy now, and you can apply through net banking through a 3-in-1 account. Okay, as I said, in offline mode, you can go to a broker, submit your filled in form, but try and apply through the net banking and UPI, which is the most easier form to apply in publication now. Again, I'm not taking too much time here because probably we do is very simple. Now, what should you do before you apply in an IPO other than checking of course, what is the gray market premium and what does the broker say? Is a very simple thing. Some points that I've tried to cover is look at the product plan, pricing, and the sustainability and growth of the company. Please try and say the company which is coming, what is the scale of that company, what is the addressable market, and try to look at the business beyond numbers. At times, numbers can fool you. I'm not saying that numbers can be, prepared, etc. But even the actual numbers can fool you. There could be some exceptional numbers, etc. So you look at the business beyond numbers. A very important aspect before applying in an IPO is look at the management quality. There is a separate section for the promoters and the management. Look at the management quality of the company, their qualification, their experience, and what is the business succession plan of the company. Is there any second in line, or is it a KMP risk? Right. Sustainable margin. If any company is presenting margins which are absolutely, not maintainable in the future market, then you should be aware, evaluate that. Stakeholders behavioral pattern means if you see a company where you will see that there could be original investors invested, whether there's a lot of changes in the investors of the company that you can see, and then of course corporate governance and corporate structure of the company. So these are few basic points that you should check before applying. Don't look at just the gray market premium or what does your broker say. At times doesn't work. Now, gray market premium is managed, and it's completely unregulated market, and hence at times managed by a lot of people just to gain from the IPO. So that's not the best way to look at before applying in an IPO. I'm moving on to what I promised. What does an offer document has? While I had summed up in one line that it has the present, future, and past of the company. Any company's offer document, you will find about the company, the business of the company, history, and certain corporate matters. In the business, you will see what is company's business model, what is company's strength, strategy, weakness, what are the products they offer, what is their manufacturing process, what are their properties, how is their competition. Everything is present in the business section. History and corporate matters section covers how the company formed up, what is if there are any special agreements within the company with any specific shareholders. The management and the promoter section of the DRHP will talk about who are the directors of the company, who are the major shareholders of the company, and the promoters of the company. Again, you will be able to assess the management quality. It also has management section, also has the company's management team, which is their key managerial person and senior management person, the head of HR, the head of IT, the head of manufacturing, CFO, CS. They talk about their experience also there. Financial statements we spoke about, you will have full-fledged 3-column or a 4-column financials for you to evaluate. There is another important section in case of in an offer document is the risk factors. One of the starting few parts, risk factors, I would suggest at least read 10 risk factors about the company. The companies in risk factors section are supposed to talk about what is the risk that the company itself feels about its business. Okay, those risk factors again could be regulatory risk factors. Some companies might have a supplier risk. Some companies might have KMP risk. एक promoter चला रहा है. What if something happens to that promoters? There is no succession plan. There is the management quality below the promoter is very poor. So one wrong day and the whole of company collapses. A company could be buying all of its raw materials from one supplier. What happens if the supplier stops? There is no long-term contract. There is a fire in the supplier's factory. All of the company's business will again collapse. So these are the risk factors which could be from industry perspective, within company perspective, outside company's perspective, regulatory risk. For example, seed companies or companies which are in any other highly regulated sectors gets affected a lot by regulatory policies. So go and read that risk factor section, at least 10 risk factors. We talk about the litigations of the company. If there is any litigation within the company, material litigation company, which could actually question the going concern of the company. Let's say if company with a 10 crore net worth has a litigation of 15 crore going on with with any tax authority. Let's say if there is a demand of 15 crore rupees, 15 crore rupees, okay, how will company pay? So that's a question on the going concern of the company. So read those risk factors before making your investment decisions, and make aware your fellow investors as well. The other part is litigation and dispute matters. What are the litigation of the company? Whether any major approval is pending for whatever the business is running. We've seen a lot of companies, they're doing their businesses but don't have fire NOC. At times they don't have factory licenses with them, but they are running their businesses. So they present all of this in their offer documents. Now you will find details about capital structure of the company, management's discussion on the numbers of the company, and again a very important section is objects of the issue. How the company is going to utilize the money that it's raising from public. That is the most important part. You have to read that section and understand whether the company is taking the money for working capital. Working capital है तो अभी तक कैसे manage कर रहे थे? If they are taking the money for capex, whether the capex will plan out as the way company is emphasizing. So make your own investment decision after reading these offer documents. At times it helps you to understand about businesses also. Like we worked on a company called Stanley Lifestyle. The story itself is very interesting about how promoter made they started their business again from a garage to a luxury sofa retailer in India now with 55, 60 stores. So those if you read the business section at times, understand how the businesses also grow from nothing to a lot, right? Other key sources before you make probably an investment decision is you can read a lot of research reports, ROC filing available on the MCA website, industry reports. There are a lot of shareholders and okay. One other thing that I would like to tell you, within all of this, where you can find all of this is there is something called material contracts and documents of the company. So any company coming with an IPO, whose IPO is open, on the website of the company, you will find all of this material information and agreements of the company for your read. You can go find the investor section on the company's website. You will find all these audited financials, industry reports, any key agreement, all of these, and the list of what they will upload on their section is also, you go to offer document, the material contracts and material document list is available in that offer document in the very end. That okay, these are the offer document, that these are the MCMD that we will upload on the website of our company, and you will find that. So again, very quickly, I have few minutes, so I'll just take how does the allotment process works. At times we feel, why don't we get the allotment? My answer to that is, it's just bad luck, nothing else. The oversubscription rules it. If I will apply through this bank or UPI से करेंगे तो मिलेगा, नेट बैंकिंग से करेंगे तो मिलेगा. I don't get allotment when this is the RTA. I don't get allotment when this is the banker. All of this nothing work. The process of allotment process is very, very genuine and very transparent. In case of oversubscription, the allotment happens on a lottery basis. So, if anything to blame for, it's most of the time it's our bad luck if we don't get the allotment. In SME, I spoke about lot size. Minimum dilution, if you see in an IPO down, whether anytime here is, any company has to at least dilute 25% of their capital. So in any listed company in India which has gone for listing in 3 years has happened, the promoters cannot hold more than 75% in the company. At least 25% has to be with the public shareholders. Insider trading, we all know. If you are applying in a pre-IPO scenario, please, please ensure that that any pre-IPO share of the company, in case of a main board IPO, will get locked in for at least 6 months from the day company gets. So if you're, let's say, investing in a pre-IPO where you're getting shares of the company and the company will go for an IPO, the day company is listed, from then to 6 months, your shares are locked in. You cannot sell. So look at those pre-IPO opportunities with this in mind, that you will not be able to sell your shares before at least 6 months is passed after the IPO. So your investment period can be very long. In case of an SME IPO, this is 1 month, 1 year after the IPO. Yeah, I think this is something that I want to discuss about. Advice to investors: don't look at gray market. Invest in IPO for long term. Not many people have made money, in a short term in India. Again, don't invest, for a short term or for a very quick buck. When you are apply, only one guy with one PAN number is supposed to make only one application. Your application can get rejected if you make 2 applications from same PAN number. And at times we, apply from our PAN number, but we make the payment of IPO money from others' bank account. So third party application process is not good. Your IPO application also get rejected because of that. So I am applying from my own account, making payments from my wife's account. My application is supposed to get rejected. Some basic advice here. Yeah, thank you. I think, sorry, I'm on the verge.
No, that's wonderful. We have also got some questions for you. You
Sure,
have
anytime.
already given a very detailed insight over how we should evaluate while applying for the IPOs. Also, how can auditors be placed at the time of IPO, and what are the roles of chartered accountants when it comes to an IPO? So the first question that we have got from the online feed is that from the modes of public issue, how is the ESOP has been classified?
Again, ESOP is not a way to raise funds. It's way of rewarding the employees. Okay, so my suggestion, if you are a finance controller, CFO in the company, encourage your promoter to issue ESOP to the company. I have seen a lot of lives getting changed because of the ESOP, and IPO does really help to the ESOP holders because then you get the liquidity. But it's not a way to, raise funds, rather a way to reward the
Yeah, it's a
employees.
basic question that I believe should have been already understood. But yeah, if it is a question I
it's
have
okay.
to ask, it's my duty.
No. It's
Another
completely
question is
okay.
that how the investor education organization at the DRHP stage comes into the picture.
See, at the DRHP stage, which is draft red herring prospectus, when the approvals goes, okay, those I don't know who these organizations are, investment, organizations, on this question, but those people don't come into play at such a real, early stage. Probably when the IPO is launched or the company is listed, probably these organizations come into picture. But my sense is don't rely on any organization to help you with. It's a very simple offer document. As chartered accountants, we are more than capable enough to understand what are the disclosures are made in an offer document. So, just do it yourself, DIY.
So there is another question which is again coming from the same kind of a journal. In the pre-subscription analysis, which agency authorized by SEBI are available to advise the retail investors free or on a subscription basis? And it is followed by another question. Are ICFAI are qualified person authorized to give investment advice on an IPO or not? I believe again this is a very basic question that we need to address here
No,
again.
it's okay. It's okay. More than happy to see. Again, from SEBI's perspective, only RAs, which are research analysts, are supposed to comment on any advice. It could be IPOs, it could be financial markets. IPOs probably still a bit unregulated because the stock is not listed. So anybody can give you an advice on IPO because the stock is not listed. Anybody can give you an advice on IPO. There is no restriction. But listed, once it's listed, the SEBI research and listed SEBI registered RE can only comment on the whatever the stock market advice that you're getting. ICFI, I'm not sure. I will have to check back. Whoever person has this question, you can probably reach out to me on LinkedIn. Just drop in a message. I'll probably try to find that answer for you.
All right. So there is another question which is coming up. This you have already touched upon the obligations of CFO. So the question is in relation to that. What are the responsibilities and obligation of a CFO while signing on all the IPO related documents? This again, I believe, is some CFO who is going under the IPO and he needs to understand what could be the possible obligations that we may have to face.
No, of course. See, as a CFO, you are signing the financial statements and the disclosure that you're making in the DRHP, right? So the obligations are similar to what you are signing as a financial statement. So whatever the financial statement that you were signing, the disclosures in true, accurate, and fair. Resultant non-compliance can lead to a lot of problems, of course. But to answer in one line, same obligation as signing a financial statement.
Signing a financial. So there is another question that strikes my mind. Being an auditor myself, for being an auditor for those companies which are supposed to go for an IPO, what do you suggest as an auditor? Like should be the points of real deliberation and real consideration at the time of signing the balance sheet and audit report prior to the IPO stage of the company?
See, don't help companies, beyond our professional capabilities. One, also understand, when you are going to be audited for a publicly listed company, a retail public would have invested. So, as a gatekeeper of audited financial statements, okay, you have to see the fiduciary responsibility the regulator is placing on you.
I
Okay,
believe this is
so
more of a responsible role than as compared
100%.
to becoming an auditor of a listed company afterwards.
100%. So be aware about fiduciary responsibilities and repercussions of being a publicly listed auditor. Okay. Also, the financials are, in case of an SME, they have to present half-yearly financials. In case of a main board, they will have to present quarterly financials. So whether your bandwidth of working on a quarter basis, providing those financial statements also works. That's more of a commercial and a business decision to make. Okay, but whether you are capable enough to support a company quarter on quarter, half year on half year, okay, whether you want to do this or not, that could be a commercial decision. But responsibility wise, please think your financials are going to be publicly available, for scrutiny and analysis. So be aware of that.
All right. Thank you so much, Mohit. Thank you so much for a detailed deliberation on the IPOs, the complete insights you have given us. Also, you have taught us how to identify yourself, do a DIY of before investing into an IPO, looking into the things ourselves. With this, I bring this session to an end. And at the end, I would like to extend a vote of thanks to both the speakers for the day. CA Kuldeep Kothari as well as CA Mohit Baser for their detailed deliberations on their respective topics. Thank you so much to both of you for taking out time out of your busy schedule and coming before us and giving us so much knowledge and deliberating upon such important topics to all of us. And with this, I would also like to extend my personal thanks and gratitude to the committee, the chairman of the committee, CA Dheeraj Kumar Khandelwal ji, for having me as a moderator for this panel. Thank you so much. With this, I believe we bring this session to an end. Thank you, everyone. Thank you for joining.
Thank you.
All the viewers also, thank you so very much for joining us.